Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. A red sweep. Republicans win the US House, giving President-elect Trump control of all three elected branches of government. Traders boost bets on a December Fed cut following a subdued US CPI report. Plus, ASML pledges growing dividends and share buybacks as the maker of advanced chip-making machines reaffirms its bullish long-term outlook.
In the meantime, a quick check on the markets. You're seeing Euro Stoxx 50 futures virtually flat at the moment. I would argue the action is in other parts of this market. Euro-dollar at a 105 handle, cable on a 126 handle, even dollar-yen seeing some pretty substantial movement. We are on intervention watch right on the cusp of 156 here. Even Brent nearing that 70 handle. Some crucial round numbers keep an eye on. The countdown to the opening trade starts right now.
Thursday morning, good morning. You've got important things happening in Europe, in Paris and in Berlin. Got a whole swathe of earnings out this morning. Swath, I guess you would probably put it if you were in the United States, of earnings out. We need to digest those. But you can't tear your eyes away from what is happening in the United States. And this is what everybody's watching, and it is impacting pretty much everything across the board. Corporates are talking about it. Politicians are talking about it. We're talking about it, Kriti. They've taken the House now, but is that actually the big story, or is it what's happening with the Attorney General and the Attorney General and what's happening with the Defence Secretary? Are those the most important things? Read the tea leaves for me. What's going on here?
Yeah, it's a really fascinating one because there's some kind of controversial picks in Trump's cabinet. Matt Gaetz is just one example. He's chosen to be Attorney General, currently under investigation from the House Ethics Committee, but a loyal Florida congressman. I think that's the takeaway across many of Trump's cabinet picks. He's picked people in his last 8 years of legal woes who have stuck with him, who've been loyal. Another example is Tulsi Gabbard, for example. She's going to be the new director of national intelligence, if confirmed by the Senate, and she's a little against anti-Ukraine aid, for example, and even she is a loyalist to Trump. He values that.
So he values loyalty. That's certainly coming through. But will all of these come to see the light of day? And you made that caveat yesterday and again today, if they are approved by the Senate. And certainly talking about Matt Gaetz, I mean, there are voices already suggesting that, you know, will this make it through a Senate that, yes, the Republicans control, but it's 53 to 47. They just need, 4 disloyal Republicans to vote against these people, and they don't get through. And so some people are asking questions if this is just opening the Overton window to the types of characters that he wants in there, rather than actually telling you who is going to be nominated in the end.
Yeah, I think it's also crucial, and we have this beautiful chart up on our screen here talking about that House majority. You started this conversation with the trifecta. Yeah. It's important to keep in mind that last Wednesday they also passed a rule that makes the bar to remove the House Speaker even higher, and that's a big deal when those deficit conversations happen and shutdown conversations happen.
Well, talking of speakers and nominations, they put John Thune in. Which is really interesting because he wasn't the guy actually many in the Trump camp thought should be, Elon Musk, etc., should be. And that maybe speaks to the idea. People have talked about him being a sort of rhino, Republican in name only, effectively. Is he going to maybe add some discipline to this process of nominations and who ultimately will fill some of these cabinet roles? Yeah,
we should mention he is a longtime deputy of Mitch McConnell. So not a surprise there, but again, has quite a bit of support within the Republican Party.
Let's talk about the inflation data. That's important as well. Or is it? I think in a world where we're getting used to the idea that we are going to see a Trump presidency and that could be inflationary, what did we learn from the data yesterday? Well, I think we learned a bunch of things, one of which was it came in pretty much in line with expectations. The market clearly was positioned for something a bit stronger and didn't get it, and that's why we got the curve steepening, and we saw an 80% chance being priced in by the swaps market of a rate cut in December. But it also signals as well that inflation is basically stalling. This journey lower is stalling, which I think is really important going into next year.
And if you think that's the bar to get more cuts after December, that we need to go lower still on inflation, and that clearly does matter. It's really fascinating, though, because we seem to be in this sort of no man's land in terms of the inflation conversation, because the Fed can't deal with things they don't know and aren't presented as fact by the Trump administration. In the words of the RBA governor overnight, we can't be jumping at shadows. And that must be a sentiment that lots of central bankers are feeling. And so you look at a lot of the Fed voices voices recently, and they're all talking about, we don't know where neutral is, and maybe it's a little higher than it was pre-pandemic. But this whole conversation, it doesn't reflect Trump or any of the policies that he might bring in. So we're sort of in this, no man's land before we get to the Trump administration and what that does.
Yeah, and I think in that no man's land, you are seeing this massive move in the bond market. Well, 446 on the 10-year. We're creeping up to 5%, and I think some of the analysts are already talking about above 5% as well. Then you got to factor in the actual growth story and the corporate earnings story as well.
Yeah, absolutely. So let's get to those corporate earnings, shall we? We're getting numbers from Burberry. First half retail comparable sales looks to be pretty in line with expectations. I mean, a touch better perhaps. They're still down by 20% year on year. The estimate was for them to be down a little bit more. We're obviously looking for what they've been doing in China because that's been such an area of focus. And the second quarter there, we're seeing sales down by 27%. So that's perhaps a worsening trend from the first quarter, which might take people's attention. But as a new CEO in post here, the previous one was there less than 3 years. And so a lot of people are focused on where this business goes next. Pricing, where's that going? Outerwear, are they going to go back to that sort of mainstay of the Burberry stable? And M&A. We've been up that hill on plenty of rumours around M&A and back again. That didn't last too long. But there's always M&A around this business that has dropped out of the FTSE 100 now.
The call starts at 8 o'clock London time. We'll see what comes out of that call and what questions are going to be asked. We'll maybe get an update on that a little bit later. A couple of other stocks, two or three other stocks I think that really stand out this morning. Siemens is one of them. The data centre boom is helping. That's really interesting. That's offsetting the automation story we heard from the CEO in the last hour. Eiffage, you look at the French company as well, similar kind of story, which is really interesting coming out of it. It is basically seeing its energy division benefiting really strongly from the AI trade. That continues. Remember, NVIDIA reports numbers next week. And Thales, the defence company, out with numbers as well this morning. It is seeing a stronger margin improvement going forward from here. This speaks again to this defence story that is going to become more and more relevant as we work our way into the Trump presidency.
And plenty of China threads coming through in the Siemens numbers as well.
And I'm sure we'll show up in the Hapag-Lloyd conversation as well. We've got that coming up on the show.
We do. We'll look forward to that. We're going to be speaking to Habben Jansen. He is the CEO of Hapag-Lloyd. Joining us exclusively, Madeleine Rohner, portfolio manager for the global equities team at DWS, is going to be joining us as well. Stefan Boujnah is going to be joining us a little bit later on in the next hour. He's the Euronext CEO. What does the Trump presidency mean for the Euronext platform? Does it change its way, the way that it's going to think about attracting listings, what it's going to do next? And we're going to be speaking to Will Silinskaiter, if I get that right, Digital Assets Research Director at Wisdom Tree, a little bit later on as well.
Let's talk about one of the other data points we're going to keep an eye on. We just got CPI yesterday. We're going to get PPI today. That coming up at 1:30 p.m. UK time, plus those jobless claims as well. And then 7 p.m. UK time, the Mexico rate decision. You want to keep an eye on this one. It's going to affect the carry trade, a peso that's already been taking quite the beating off the Trump trade as well. So interesting to see what Mexico has to say on that. At 8 p.m. UK time, of course, all eyes on Chair Powell. He's going to be speaking at an economic outlook in my hometown, Dallas, Texas. Very exciting stuff. And then today, of course, we are keeping our eyes on the Mansion House speech with Rachel Reeves.
Yeah, and we already know a little bit about some of the policies she wants to talk about, at least at Mansion House, given that she gave an interview to our colleague Lizzie Burden just last night, and we had that coverage, and that's all around pooling local authority pension funds to try and get more money in a bigger way going into infrastructure spending. No compulsion to keep it in the UK, though. So, we'll see whether that is actually able to deliver against those ambitions. And we'll see what she has to say on trade and the Trump administration, because that could be something that she wants to talk about as she's here in the City of London later.
The UK is a small, open economy. She has to push back on the idea that we're going to be seeing a lot of tariffs coming through. That would not be good for the UK economy. The pension thing, I think, is interesting. She's talking about creating 7. If you aggregate them together, I think it's 7 or 8. The UK pension funds could be huge and actually have a meaningful impact.
She wants to copy sort of Australia, Canada and the like.
Look at was it Australia or Canada, I think, just invested in UK airports. You get these big pension funds actually investing in UK infrastructure in the way that UK pension funds aren't at the moment. Be interesting to see whether or not she's onto something, whether or not this actually does change the narrative. I hear what you're saying about the fact that they're not being required to invest in the UK, but actually are there the opportunities? Other large sort of pension funds are seeing opportunities in the UK. Would our pension funds here see those opportunities as well?
Some of these numbers are staggering. 80 billion pounds of kind of investment into infrastructure. Suddenly that just makes, when you're looking at investing in infrastructure and private equity, et cetera, those deal premiums go even higher than they already were because of a number like that out of Reeves.
Yeah, well, we'll see whether this is the thing that will bring that private sector investment that she needs if she wants to deliver on the growth pledges.
She's going to need some growth if the numbers are going to stack up. Let's talk about what else we need to know this morning and figure out what is going on. Bloomberg has learned that Banco BPM will likely be amongst the bidders for a stake in rival Monte dei Paschi. That is being sold by Italy's government. The Italian state said yesterday it is offloading a 7% holding, the latest step in an exhaustive restructuring drive that, of course, dates back to 2017. Staying in banking, BBVA's CEO says he is prepared to walk away from the firm's bid for rival Banco Sabadell if regulatory conditions make the deal less appealing. The comments come a day after the Spanish regulator deepened its assessment of the proposed deal, extending the process by months. And the French far-right leader Marine Le Pen faces being barred from the next presidential election after prosecutors in an embezzlement trial asked for a 5-year ban from public office. Le Pen and members of her national rally are accused of diverting millions of EU funds to build her party's platform. Le Pen denies the allegations.
Goods inflation is back down to where we want it to be, where it was pre-pandemic. Services inflation, which is tied to wages, is gently trending down. And then finally, housing inflation, we know, is a lagging indicator. We know that it takes a couple of years for the new leases to turn over. And the new leases are showing that we're headed in the right direction. So right now, I think that inflation is headed in the right direction. I've got confidence about that. But we need to wait. We've got another month or 6 weeks of data to analyze before we make any decisions.
Neil Kashkari, Minneapolis Fed president, speaking to Bloomberg, talking about the idea that inflation is heading in the right direction. Increasingly feels though it is stuck a little, kind of around these levels, and it's going to be interesting, therefore, to see what the Fed does after December. Let's get more details as to what is happening here with Bloomberg's Valerie Teitel.
Good morning, Guy. That is the right way to put it. We did see quite a stall in the progress, especially when it comes to core inflation. It was the third month in a row we got a 0.3 reading month on month, which is not good news because if you annualize that, it takes us farther away from the Fed's 2% target. However, it seemed the market was more worried about the risk that we would get a 0.4. They were actually quite relieved we got that 0.3. We saw a rally in the front end. We're now pricing an 80% chance of a Fed cut come December. But the back end had a very different memo from yesterday's session. Let's switch on and just look at how the 30-year yield fared in yesterday's session and overnight. It tried to rally, Guy, after that CPI print, but the bond vigilantes out there said no way. Traded very poorly over the course of yesterday's session, at one point being higher by nearly 10 basis points. Now, to me, Guy, this is the bond vigilantes out there saying we are worried about that climbing fiscal deficit. We got news of that Republican sweep yesterday, as well as some news that the October budget deficit for the U.S. came in above expectations. Take that all into account, and that is telling us that we have a bond market still worried about fiscal spending to come. We also have one more thing we need to watch out for the bond market today, which is Powell speaking at 8 p.m. London time. Notably, he is speaking after the PPI print, so he will have a good read on what the Fed's favored measure of PCE inflation will be for this month. We are going to be looking out for any hints that his language changes when it comes to the December meeting. He will get asked, or he is very likely to get asked about the Fed independence and what he thinks about a Republican administration who seems to want to be more involved in his interest rate decisions.
Great stuff. Thank you very much indeed. Perfect setup for our next conversation. Raphael Gallardo, chief economist at Carmignac Gestion, joins us now. Raphael, great to speak with you. Has U.S. inflation, the progress lower? Do you think it's stalled?
I think on the CPI, yes, we're seeing that progress had stalled around 3% on core. But I don't see anything in yesterday's report that should take the Fed out of its strategy of recalibrating rates by at least 100 basis points. The Fed has been very clear that they don't consider housing inflation to be a reliable indicator of inflation. They point to market trends falling. They're very happy to see that core goods inflation is back to the level it was in the 2000s, when we were in the golden age of globalization. And as far as services inflation is concerned, I think they have their eyes on the labor market. And Mr. Powell has been very clear that for them, the labor market is no longer inflationary. And they say, yes, wage inflation is a little bit sticky, but productivity is strong at the moment. So it's not a definitive judgment that inflation is going back to target. But for now, I think there is nothing to take them off their strategy of recalibration. So I think December is a done deal.
OK, December's a done deal. What comes after that? And what comes after that becomes really interesting. The beginning of next year, we're going to get the Trump administration coming into power. What do you think the lag is between the arrival of the Trump administration and the perceived inflationary impact that that administration will have? How long before Trump starts showing up in the inflation numbers, do you think?
In my mind, I think the Fed will start to worry again about inflation by the middle of next year. Because there are many wagons in the train in the next wave of inflation. And so this train will start with a boost to confidence in the economy by Republican voters, SMEs. I think we will see the NFIB Small Business Confidence Survey rip up higher as soon as next month. There will be also hope of tax cuts that I think will also bolster company spending on hiring and capex. So that will be the confidence wagon of the train. And then there will be also probably another fiscal wagon to that train. But it will take longer because here we need the Republicans in Congress to agree on a mega reconciliation bill. And this could take a little longer. But we're seeing that the market has already reacted, anticipating that the economy will get hotter and that inflation will come back as a risk next year.
OK, Raphael, good morning. So there are different waves or different wagons, as you put it, to the way that the Trump story plays out for the US economy. I wonder how we deal with central banker conversations around inflation in this environment, because we heard from the RBA governor, for example, overnight saying we can't be jumping at shadows when it comes to talk of what Trump might do. We have to wait to see what he will do, and we can understand why central bankers would say that. But on the other hand, to ignore the risk of higher inflation from a Trump presidency seems to be ignoring something quite potentially risky. So how do you deal with how do central bankers deal with that lack of visibility?
Well, I think the central banks are kind of lost. That is a very uncomfortable position they are in. I think that after the pandemic, someone like Powell, they have completely lost confidence in their macroeconomic model, in the forecast of their staff. So that's why they are data dependent and why the Fed is in a very awkward situation where they say that they are data dependent, but it's pretty clear that they have this recalibration strategy in mind. So their communication is at pain. But I think that there is no way for them to try to anticipate what Trump might do. And unfortunately, they're facing an administration who has accustomed us to being quite erratic in terms of decision making. The first Trump administration, it wasn't like the Biden administration, where decisions were, flowing from the top to the bottom with a clear vision. Now we know that under Trump, if it's in the first mandate, it's different factions vying for the president's attention, and who don't know, who wins the day, day after day. So yes, they're facing maximum uncertainty, but there is no way to try to anticipate or make a bet because they know how dangerous it would be for their independence.
Raphael, talk to us a little bit about the tax regime here, and not just in the context of the United States, which is largely expected to decrease taxes, but certainly in the context of a lot of European countries increasing their taxes. What does that do to fund flows and growth and stimulating that growth?
Well, I think the situation is completely... we have polar opposites between Europe and the US. We know that in the US, populism won this election, and there is a strong political impetus to cut taxes, although I'm not sure that the Republicans in the House are really on board with everything that Trump would like to do. But on the other hand, we know that in Europe, markets have signified to a number of countries that they have run out of fiscal leeway. So the big problem that I see is that if we have more fiscal easing and an overheating in the US economy, there will be a spillover effect through long-term bond yields to Europe, unfortunately at the wrong moment for Europe, because it will decrease further the fiscal space that we do have in Europe. Basically in Europe, the only country that has fiscal space is Germany, but they're still in a fiscal straitjacket that they have imposed onto themselves, and it has led to the fall of the government. Yeah. But my fear is that this discrepancy could actually make things even worse for Europe by the correlation you have between the long end of the US bond market and the European bond market.
Raphael, very quickly, you talked about the German debt brake. What are the consequences of that? If the debt brake is removed, how quickly could the slippery slope fall, I guess, for lack of a better term?
Well, I wouldn't call it a slippery slope. I would call it kind of salvation for Europe. If we can get the Germans to spend more, there will be some multiplier effect on the rest of the Eurozone. But I think the key issue is also increasing the efficiency of fiscal spending in Europe. And we know, and that was a key message of the Draghi report, that we need to be spending this money together on trans-European projects. But I think we're very far from, one, getting rid of the debt brake in Germany, and two, getting the Germans to agree to mutualize their fiscal space with their European partners, unfortunately.
All right. Raphael Gallardo, Chief Economist over at Carmignac Gestion. We thank you so much for joining us around the table. Guys, it's a really fascinating kind of topic that he's saying here, that if it's not a slippery slope, it's salvation for Europe if the Germans spend more. Do we see that happening?
That's the view from Paris. Yeah, we'll see. We'll get the view from Frankfurt and Berlin.
Do they need to spend more? What happens if Germany cuts taxes? What happens if Germany is able to at least revitalise its economy? That'll be really interesting. The whole trade narrative needs to be folded into this as well. We'll continue that trade conversation in just a moment. Hapag-Lloyd CEO is going to be joining us. We'll talk about earnings. We'll talk about global trade. We'll talk about tariffs. That conversation coming up with Rolf Habben Jansen next.
Welcome back, everybody. This is the opening trade. 30 minutes until the start of European equity trading. And the futures picture, let's have a look at where it leads us right now. Not giving us a very clear picture. Perhaps some positivity for European stocks. CAC futures, maybe not so much, but Euro Stoxx 50 futures are up by 0.4%. US futures a little more sluggish, down 0.2 on NASDAQ futures, and E-minis down 0.1. Let's have a look at the bond market. Our last guest had really interesting things to say about where the impulses are going to come from that will influence the European bond market. And he was saying that if we do see higher inflation in the United States, then we might get that higher yield from the US, having that transatlantic read across into European bond markets, just at a time when Europe doesn't need higher bond yields, and the ECB is trying to do something different and bring down those debt costs, of course. But this is the direction of travel that we see right now. Fairly small moves in bond markets right now, but slight moves higher for European bond markets. Something that is moving higher this morning is the gas price around Europe. So the natural gas price, TTF, listed in the Netherlands, up by just under 4%. The UK natural gas price also rising in sympathy, up by 4.3%. And this is all to do with supply of gas from Russia and where it's vulnerable. So OMV has actually won a court case against Gazprom. The difficulty is, if you win a court case against Gazprom, do you then trigger some negative response from Russia? And that's what now the gas markets are fearing.
So the price is picking up. We're at, what, 45 on TTF. I guess way away from the north of 300 that we saw, obviously, during the major crisis that surrounded Ukraine. But it is going to... Here is another factor that is inflationary. This is going to get factored into the European energy story as we work our way into the winter. We don't yet know what that winter is going to ultimately look like. But it's just another factor. Europe has seen energy prices coming down. That has been a contributing part to what we've seen in terms of the CPI data we've seen recently. Is that about to start reversing? Has that already started to reverse, actually, in some of the countries that we're seeing reporting numbers? So, yeah, here's just another factor that makes life really tough for the ECB. Talking about central banks and what they're going to be watching, the fiscal story is front and centre for many of them. Here in the UK, that is certainly true. So a little later on, we are going to be hearing from the Governor of the Bank of England. He's going to be speaking at the Mansion House. Also speaking at the Mansion House a little later on is going to be the UK Chancellor, Rachel Reeves. She's going to give her Mansion House address tonight. And Lizzie Burden sat down with her yesterday to give us a little bit of a preview. So talk about what is going to come out of this speech, how significant is it, and what are the milestones we should be watching out for?
It's really significant. It's her first Mansion House address. It's the big moment to woo the city since the election. It builds on the investment summit and the budget. And, of course, things have been pretty uphill after she wiped the slate clean there. The vision is based on 3 pillars: stability, investment, reform. And so we're expecting her to cut red tape, tighten her grip on watchdogs, and in our conversation, some interesting hints about what she's going to do on pensions as well.
Yeah, absolutely. Talk to us about the pension story then, Lizzie, because she's not the first government to want to try to pool some of these pension resources so that they can co-invest alongside the public sector to allow the public sector to get more from its investments in infrastructure.
Exactly. Jeremy Hunt tried it. George Osborne tried it. I asked her what's the difference this time, and she says we're actually going to legislate on it. So they're pooling £1.3 billion worth of money to make a mega fund, and they say that'll generate £80 billion worth of growth and benefit savers as well. Take a listen.
What we don't have in the UK is mega pension funds. We don't have those economies of scale in our pension funds, which is why the interim report that we're publishing looks at having a minimum size of 25 or 50 billion pounds, similar to what you have in Canada and the United States. Those sorts of mega funds will have the expertise to make those investments, both in start-up and scale-up businesses and in British infrastructure.
So she's making the point that size matters, but there are 2 issues here. First of all, you've got to make sure that that money actually goes into UK companies when you can get juicy returns elsewhere. She's not going to mandate that they put the money into UK companies, nor is she particularly keen to give tax breaks like Australia, even though this is kind of inspired by Australia. And then the other issue is how do you get more money into the pension pots in the first place when you've just whacked a load of tax hikes on employers and lifted the minimum wage? And again, not such a clear answer there. So it will be difficult to see how different this is from Jeremy Hunt or George Osborne before her.
All right, Bloomberg UK correspondent Lizzie Burden walking us through her comments, or her conversation, around Rachel Reeves. Of course, we'll be looking ahead to that Mansion House speech later today. Let's talk about one of the major corporate earnings stories that we got this morning. Hapag-Lloyd says profits for the full year will come in ahead of average estimates. The German shipping giant saying that the first 9 months of the year were marked by, quote, unexpectedly strong demand. I'm pleased to say Rolf Habben Jansen, CEO of Hapag-Lloyd, joins the program now. Rolf, a pleasure to have you on the program. Good morning from London. Walk us through some of your numbers here, some positive ones for the third quarter, but some concerns perhaps on the horizon. Walk us through those concerns.
I mean, there's always concerns on the horizon. I think there's a lot of uncertainty in the market right now. But having said that, we've seen very strong demand this year. And also, if we look at how we started up in the fourth quarter, I think we've seen demand coming back again after the October holiday. So from that perspective, at the moment, things look actually fairly positive.
Rolf, talk to us a little bit then about some of these shipping costs, which feels like are ultimately boosting the revenue and the numbers over at Hapag-Lloyd. But there's a lot of concern in the broader market around the geopolitical volatility, specifically as a function of a Trump 2.0. How is the read-through looking in terms of your numbers, not just in the next quarter, but say the next 12 months?
I mean, it's always very difficult to look ahead 12 months because if you go 12 months back, everybody expected a very difficult 2024. And of course, because of everything that happened, the year developed very different from what we expected. If we look ahead at the moment, I think we see pretty strong demand for the upcoming weeks and months looking into next year. Difficult to predict. I mean, if we look at what happened when Trump was in power the first time, then we saw actually a fairly healthy market during most of his tenure. So I'm actually fairly relaxed about that. And yes, we will get some surprises probably, but normally demand then just moves around and it doesn't disappear.
That's really interesting. So you're fairly relaxed and you think that the trade then is reshaped. The global picture around trade is reshaped rather than being substantially reduced, Rolf. Is that your expectation of a second Trump presidency?
I think that would, at least for now, that is probably our read. I mean, dependent on what kind of tariffs will be implemented. Of course, we will see that some trade flows will be less, but normally those tend to move around. If we look at what happened when Trump was in power the last time, then we definitely saw, for example, the flows between China and the U.S. coming down, but we also saw that imports into the U.S. from other markets were actually going up quite significantly. So if you look at his and higher tenure last time, then global trade was still developing fairly well. Yeah.
OK, that's a really interesting observation from the first presidency, and we'll see if that is replicated or not. As you say, depends on the exact nature of the tariffs. Can I ask you about the very short term, Rolf? Do you have an expectation that we see volumes and maybe even prices pick up if people want to get ahead of a Trump presidency, if people want to get shipping done ahead of the potential tariffs coming in?
I think that's definitely, that's likely, I would say. I mean, if we look at what happened also just before summer, then we saw that also on the back of the Red Sea crisis and ahead of a potential strike on the US East Coast, there was definitely an early peak season. And I would not be surprised if now, running up to Chinese New Year, we see pretty strong demand as people will try to get their goods into, especially the US, ahead of the moment that Trump gets in power.
Rolf, do you think another East Coast strike is less likely with the prospect of a Trump administration coming in? How would you handicap that?
I mean, I would really hope that we can avoid a strike. I know that talks are about to start between the ILA and the USMX, and hopefully they will come to a good landing before middle of January. I think we've taken a very important step forward a couple of weeks back when an agreement was reached on, or at least tentative agreement was reached on salaries, and now hopefully we'll be able to resolve the other items as well in an amicable way.
You mentioned just a moment ago what is happening in the Red Sea. What are you seeing in terms of shipping rates? Is there any inclination at the moment to see rates going lower? What are you expecting in terms of the new normal that maybe we have to get used to the idea that the Red Sea is going to be closed? What is your current thinking on that?
I think my current thinking on that is that at least what we saw this year is that initially rates spiked in January. Then they came back to a much more normal level in the traditional low season. Then they spiked again in a fairly normal seasonal pattern when we went into peak season. Then afterwards, we saw them again coming down. We may see a spike again as we run up to Chinese New Year. But I would expect that if you look longer term, assuming that the Red Sea will be closed, then yes, then rates will probably settle at a higher level than where they were before. Simply because we need more ships and also cost will be higher.
Well, Rolf, I want to circle back to the point that Guy made earlier around the port strikes. And you mentioned that there was a tentative agreement in October that's only pushed out till January of 2025 and potentially prior to when President-elect Trump actually takes office. At the same time, there are port strikes in Canada as well. And I'm curious what the read-through is into some of the costs that you're citing there.
I mean, if you look at the situation in Canada, I believe that now they're going to binding arbitration, which I believe is good, because that will mean that the ports will open up again. I mean, I don't think there's a lot of read-through for the U.S., to be honest. I think the U.S. is a very different situation. There we have at least made a good step forward by coming to a tentative agreement on what's going to happen to salaries. And now we have a number of months to negotiate between USMX and ILA to get to a full agreement, and hopefully they'll reach before the middle of January.
Can I ask you about new container ships, Rolf? I understand that you've recently ordered 24 new container ships for around $4 billion. From what you said before, you're not too concerned about what Trump might do to the volume of global trade. Did that go through your mind at all when you're making such a big order?
No, I think when we make those type of decisions, we look what is needed for the next decade or for the next 2 decades, because we buy these ships typically for the next 25 years. For us, the main reasons to buy those ships is to replace older ships that will be taken out of service towards the end of the decade or beginning of the next decade. And of course, newer ships are also still quite a lot more efficient than the older ones that we are going to take out. I mean, when you look at, for example, fuel consumption of those newer ships compared to the ones that we will take out is about 40% less per container. And that's, of course, a big amount. And that helps us also to further reduce our emissions in our journey to become carbon neutral, hopefully by 2045.
Rolf, do you think the pressure is going to be lower as a result of a Trump administration to be carbon neutral? Do you think the pressure will be off as a result of what is happening in Washington?
I don't expect that. I think that we may see some. It may be that temporary the pressure is going to be a little bit reduced, but I do think that the pressure to decarbonize will stay. Yeah. And it will not only come from the US, but also from many other countries. And yes, it may be a little bit less for a short period of time, but when you look out when you look at the next 5 years or the next 10 years, then for sure we will get a lot of pressure to decarbonize. And I think that's also, in the end, the right thing to do.
Rolf, we spend a lot of time on this programme, on this channel, talking about the strength of the US economy right now and the challenges that the Chinese economy faces at this point. Do you see anything in your data? What clues can you give us around the strengths and weaknesses in China at this point?
Very difficult for us to judge. I mean, we only see the exports, of course, out of China. I think we've seen exports being fairly robust throughout this year. I think we see the same things as you do, but to be very honest, we only look at trade flows and the bookings that we get. And looking at that, I think this year has actually been significantly better or stronger than was originally anticipated. And luckily, we have all invested a lot in new ships over the last couple of years, because that allowed us to keep those supply chains flowing, even if we have to go around the Cape of Good Hope.
All right. Rolf, Habben, Jansen, we will keep the conversation there. CEO of Hapag-Lloyd joining us this morning out of Hamburg. We thank you so much. It's certainly a stock we're going to be keeping our eye on ahead of the opening trade. Coming up, we're talking about another stock, a German stock as well. Siemens managing to offset the global slump in autos manufacturing with its bet on data centers and automation technology. Your stocks to watch coming up next. Stick with us. This is Bloomberg.
Welcome back to the programme. This is the opening trade, and we have a European futures picture that looks flat to positive. US futures actually improving slightly, just at the margin, flat to negative over in the United States right now. Joining us now to talk about the markets in 3 minutes, our Markets Live executive editor, Mark Cudmore, with us, of course, from Singapore. Good morning to you, Mark. From London, let me ask you about your view on US stocks, because I think it's changing, shifting, with some of the dynamics we're seeing post the election of Trump for a second time. So we see, I mean, the dollar is higher, yields going higher. Is that the thing that's going to damage sentiment around US stocks, or what do you think?
I think that's part of the story, Anna. Good morning. I think that the whole dynamic around US stocks is making a binary shift. For all of 2024, you know that I've been the adamant perma-bull in stocks, and the main dynamic there was that people were too negative on the US economy. They were too worried about rising yields, and as I've always argued, is that if you get rising yields because of a strong economy, they shouldn't derail stocks. They'll only derail stocks when rising yields start constraining the economy. What we're seeing now is a complete shift. Rather than stocks climbing the wall of worry, we're just seeing sudden extreme exuberance at these much higher prices. I was at a Lehman reunion party last week, and I don't know whether that's clouding my judgment or maybe the excess alcohol consumed at the time, but suddenly it seems like everyone I speak to is just super bullish for a common of almost the opposite reasons they were before. And obviously earnings season's been good. It was expected to be good. We knew the economy's held up strong in the third quarter, but people don't seem to be noticing that forward estimates continue to get slashed. The analysis of Trump policies is very, very unnuanced. Even, you know, the analysis of what it means, tariffs mean for the US economy might be clouded by political bias, but no one argues it's bad for global growth, which should affect the earnings of US multinationals. So I think that the stronger dollar is a problem. And at some point, I am worried that, you know, we will see these higher yields constrain the economy. And we're seeing a little bit of fragility in the labour market, which I think has been dismissed because of the hurricane and probably incorrectly.
Mark, a few weeks ago, we all got very excited about the China trade, and we were talking about what would happen next and whether or not this trade had legs. It didn't have legs, and it feels like actually many people are taking money out of Europe, out of China, out of everywhere else to put money to work in the United States right now. Has the China trade already run out of steam? Is India going to follow? And does that money ultimately still, though, flow towards the United States?
I think that's the narrative people are trading at the moment, but I'm not sure it's correct. Look, China stocks are still a chunk higher than they were. Hong Kong stocks are still officially in a bull market. I think they've been there since May. That story has pulled back a lot further than we thought, but we're still getting continued policy support there. I certainly think the narrative is very, very pessimistic, but I think that story is still probably not brilliant. It's definitely negatively affected by the Trump story, but I don't think there's excess optimism there. It's negativity which is roughly okay calibrated. I am more worried about the stock markets where there's excess positivity priced, excess optimism priced, and I think that possibly now includes US stocks. It didn't before. I think it probably does include India stocks. That's a story that even though the economies aren't very linked, the asset story is very correlated to US stocks, and I think it's vulnerable.
All right, Bloomberg Market Live executive editor Mark Cudmore, we thank you so much. You get more up-to-date analysis from him and the team. Just type in MLIVGO on your Bloomberg terminals. Go from the macro to the micro. Get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So we've got some decent numbers out of Siemens today as their data focus overshadows some weakness in the automated factory business, and the CEO of the company spoke to Bloomberg earlier today.
We have a record high net income of 9 billion. We have 15.5% profit margin in our industrial business, and we are extremely happy about the free cash flow of our industrial business, which is 11 billion. 9.5, by the way, all in. So therefore, we are very happy. We are very happy, and we are looking forward to another strong fiscal year in a difficult market environment. So we are guiding a growth of 3 to 7% going forward.
So that was the Siemens CEO speaking to Bloomberg earlier today. As we can see from the screen here, there was a bit of weakness the last time the company gave results, given the softness in the automated factories. But potentially these numbers today should be strong enough to avoid a similar situation for that stock. Then in terms of luxury goods, we got Burberry, this one looking really, really bad. The company predicting sales down 35% in the year ahead. That is bigger than the 30% drop they previously guided for, double-digit declines across their regions as well. In terms of the long-term performance for the stock, it's down more than 70% on a two-year basis, underperforming a big drop that we've seen recently this year in some of the other luxury names. And if we look on the analysts as well, 7 sell ratings, by far outweighing the buy. So potentially some of these declines in sales might already be priced in, but definitely one to watch in the luxury UK space today. Then over in banking, the Italian government selling another stake in Monte dei Paschi. That was last night in an accelerated book build. Banco BPM, the rival, picking up a chunk of that stock. And analysts over at JP Morgan writing today that they reckon this could signal that Monte Paschi becomes an eventual takeover target, and BPM will likely be one of the bidders, according to analysts at the bank in a note this morning. If we look on this stock on a long-term basis, down 80% over a 5-year. It used to trade at around 45 euros. It's now just above 5 euros amid long-term capital issues at the lender. Then staying in the banking focus in terms of rating changes, a couple of downgrades, a couple of decent punchy ones. ABN AMRO over in Amsterdam, that's an underweight at Morgan Stanley. CaixaBank in Spain, that is a sell or a reduce over at Kepler Chevron. And finally, in renewables, Restas cuts a hold at Berenberg this morning.
Thank you very much, Joe Easton, on Stocks in Focus. I'll add in another one. This is Stadler Rail, Swiss train maker. And the reason I mention this is they're pulling their guidance as a result of the weather disasters, including the floods that we saw in Valencia. They're unable to deliver, supply chain disruptions as a result of that. So, you know, another example of where we see some of these climate change-driven activity having an impact on supply chains. Talking of climate change, Equinor making an oil and gas discovery in the North Sea. It's a fairly substantial one. It'll be interesting to see how that reacts. The UK, obviously, I bring it back to the gas story that we were talking about a little bit earlier on. And the last government's maybe more benign sort of operating environment when it came to the North Sea and trying to push it, maybe a little bit harder, again, then speaks to the idea of what we're going to see over in the United States. I think the connections are reasonably tenuous, but we'll make them just for now. But it's interesting. As a result, maybe, of what we've seen recently, we're starting to see oil discoveries being made back in the North Sea. We'll see how Equinor trades off of that in just about 5 minutes' time or so. A quick check on the futures picture, because you are seeing some outperformance in Amsterdam, and it does feel like a lot of that is coming from those ASML numbers. Even though they didn't meet guidance, they affirmed that guidance. It looks like the markets, at least in pre-market indications, are pointing to a very much higher. Green on the screen across the board. FTSE 100 flat. The opening trade's up next. This is Bloomberg.
Thursday morning, good morning. Broadly, it looks like Europe's actually going to open a little bit higher, which is interesting given the fact that we priced in the updraft yesterday over in the United States. We didn't price in necessarily the fade that we got at the back end of the session. I know we're all focused on Trump. I know we're focused on what is happening at the Fed, but actually there's some quite interesting corporate stories that need to be folded into the narrative today as well. And I wonder actually whether they will have an impact on what we're seeing in futures and, by extension, into the cash trade, Kriti.
It's certainly an interesting one. You are seeing futures indicated higher, 0.7% on the Eurostoxx 50. By comparison, the FTSE 100 lagging by a massive margin, flat on the day. But a good chunk of the outperformance, Guy and Anna, is coming from Amsterdam. That idea of ASML, several other stocks as well, lifting that index higher. It's not a futures index we look at that substantially, but it is certainly changing the numbers on those Eurostoxx 50 futures.
Yeah, let's have a look at some of the individual stocks then that could be on the move as a result of some of the earnings stories and other news flow that we've seen this morning. Let's start with Siemens, the German industrial business, pitching strong data centres as helping to offset the automation slump. That automation slump, of course, partly driven by China. The CEO saying this morning that China will come back, though, saying that in an interview with our colleagues here at Bloomberg. ASML in focus, no change to that overall sales guidance. Could we see a slight tick up in the shares at the start of trade? Perhaps AI described as the next big driver in chips. I thought it was the current big driver in chips, so that took me by surprise. Let's talk about Burberry as well. Really interesting one there, of course. The new CEO, Joshua Schulman, has come into the role, and we got the numbers through from Burberry just a few moments, 50 or so minutes ago, and they didn't look hugely dissimilar to expectations. But interesting to get his comments saying that the label needs to course correct after the sales dive, Guy.
We'll get some more details in just a moment. The call will be starting any second now at Burberry with analysts, so we'll get the details off that for you. Let's talk about the opening trade. Here we go this Thursday morning. We are expecting European equities to open a little bit higher, with the exception of the FTSE 100, which actually is in the green, but not by much, as you can see, barely budging off the flat line. So I suspect we're going to be in and out of positive, negative territory on that one. The IBEX, though, is up by 0.2%. The expectation is that we're going to see 2, 3, 0.4% for the major markets across Europe, backing out the FTSE 100 from that, and we're already seeing it maybe challenging that initial bit of green with a little bit of red. But the CAC 40 is up. It's up by 0.4%. Kriti was flagging what's going to be happening with the Amsterdam market. I don't have that on the board. We do have the DAX and the SMI. We'll wait and see what they do in just a moment. It'll be interesting to see what happens with Siemens at the get-go this morning, Kriti.
Yeah, it's a fascinating one. I'll answer that. We are still waiting for the index level on the Amsterdam index to open. But broadly, it's ASML that's behind the screen on the screen. You're seeing it in the stock 600, for example, the biggest index contribution to the upside, higher by about 3% on that initial stock, and taking with it the entire tech complex. On the FTSE 100, to you guys' point, Anna, it is not the exact same story. Commodities seem to be on the back foot today, and that's showing up in the underperformance.
Yeah, we saw iron ore prices down by 1.9%, I think, towards the end of the Asia trading session, and that can quite obviously have an impact on those basic resource stocks. So we certainly do see some of that. But technology, yeah, absolutely right to focus there, because that does seem to be the best performing sector. And by a little margin, up by 1% or so this morning. In terms of the other stocks that we're focused on then, so ASML is one of those gainers, up by 2.5% this morning. We also have Equinor trading higher. Guy, you were mentioning this one earlier on. That stock is up by 2.5%. We're waiting to see what we get from some of the other companies that we talked about. In fact, Burberry, waiting to see what we get there. So we'll bring an opening price on Burberry shortly.
Energy stocks broadly are, though, higher. So you've got Total up, BP is up. I think Shell goes ex-dividend today. Just that's one's at the back of my brain in terms of maybe the fact that that could be why it's not on the list that I'm seeing in front of me. But the energy complex broadly does seem to be higher, which is interesting in the light of the fact that we are seeing the miners a little softer this morning. But LVMH is soft this morning. It's down by 1%. It is the leading point drop on the stock 600. But there are some miners in there. But the pharma sector as well, seeing some signs of weakness. Roche, Sanofi, AstraZeneca, all soft as well. I think GSK might go XD
yeah,
too.
You're correct. GSK and Shell and Sainsbury's.
Excellent.
We should mention that Bayer is also taking a pretty big beating today, down about 2 to 3%, and it was on top of yesterday's numbers as well. This is some continuation of weakness there. They'd cut their earnings target yesterday, posted a net loss in their agricultural weakness story. So as well, that's going to be one we're going to keep an eye on. We're going to talk about how this index is going to go broadly, though. Are we still in this economic resilience narrative out of the United States, or are the tides changing? We spoke to that very topic about Deutsche Bank's Henry Allen. Take a listen to what he had to say.
I think the US is still the best bet in terms of where things are going next. You know, the US is still the best bet. It's just on a relative basis, you're not necessarily going to see the relentless rally that we have for the last couple of years.
So
Joining us now is Madeline Ronner, portfolio manager at the global equities team over at DWS. Madeline, a pleasure to have you on the program. Thank you, as always, for joining us. Look, the narrative continues to be kind of a tale of two camps, really. I mean, this feels like a tale all the time, bulls versus the bears. But the idea that there might be some sort of sentiment change, that the U.S. is no longer the place to be, do you agree with that? Is that the sentiment in your view?
I mean, honestly, like with the Trump election happening last week, and with that also being such a clear sweep and him having such a strong mandate now, so we expect tariffs to happen pretty early on in his presidency. Obviously, we all know that he can do that like off the bat. So obviously that's going to be a problem for export-oriented Europe, right? And if you just look at the history, like usually. When the first day after the election is a positive for the S&P 500, usually it goes up in the 2 weeks after. So we strongly expect actually the US to be kind of still the place to be, at least until year end. We still like European stocks generally for next year. I mean, there are some good reasons too, like the stronger dollar will help EPS growth generally. You still have the valuation discount, so it's important to watch what the 10-year yields are doing in the US, because if they get too high, the valuation of the US equity market could get problematic, and we saw that also in the tape on Thursday, on Friday, last week. And that could play in favor of European stocks, who are obviously much cheaper, even on a sector adjusted basis. But generally, especially until the end of this week, going into a year-end rally, US will likely, in our view, remain the place to be.
Madeline, you mentioned the rates picture as well. Give us an upper bound here on the 10-year that you may actually see the stock market have far more sensitivity to. At one point in the last couple of years, it was 5%. Every time the yield hit 5%, the stock market dropped. Is 5% still going to play that role?
I think so, yes. So if we would see 5%, I would expect especially the U.S. equity market to react to that. We think a large portion of the Trump trade and also the deficit is likely has been priced in before, right? In 2016, it was a large surprise that he got elected. This time, not so much. So the rates already went up in anticipation on the election. But we will still likely see some upwards pressure there. So that's going to continue to be a watch item for us. If it approaches the 5%, we would surely expect that to have a negative impact on equity markets. But let's see if it even goes there, right? I mean, we had the inflation print yesterday, so that was in line. That gave the Fed room to cut in December again. It comforted markets. So item to watch. But yeah, surely the 5% would become an issue.
Madeline, let's just talk a little bit about catalysts and what could be a catalyst. Is there a catalyst for Europe? Is there an obvious one? What could it be? Everybody I talk to seems to just think that you want to go to the United States, and that seems to be the logical trade right now, and it certainly has been. Is there any reason to buy Europe?
I feel like, for example, if you look at Germany, the DAX has been faring quite well, especially regards to the export-oriented nature of the German economy. But it has been doing quite well because obviously we're getting a new government, likely in February next year. There has been a lot of indecisiveness around that. We have the strong view that the German government has been spending way too little compared especially to other Western economies. So if that would start to pick up and we would really get a large majority there that could really achieve new policy items, I feel like at least for the German stock market that could be a trigger. Otherwise, we'll have to see if some valuations pops up in the US. Yeah.
Are valuations important? It feels like they're being downgraded at the moment. People talk about many reasons why you want to own equity markets at the moment. Traditionally, you talk about valuations. I just don't hear valuations being talked about a great deal. Are they still important?
I feel like something needs to happen for valuations to be important again, right? So either like the 10-years have to go up, you would have to see some kind of inflation reigniting. And obviously Trump's policies will be inflationary, but that takes some time, right? So you will not see that right away. And I feel like the Fed, I mean, they said, okay, they're not going to react to the Trump election right away, but at some point they're going to have to, because simply that will lead to higher inflation longer term. Inflation pressure will go up. And if something like that happens, that could lead to valuations mattering more again.
Madeline.
But, yeah.
Yeah, sorry, I think you froze briefly, but you're back, so that's good. We'll persist and hope that the connection it remains stable or becomes stable. Let me ask you about Germany. Guy was asking about the European broader story, but on Germany, you say in your notes ahead of our conversation that a US tariff on German imports would deduct some 0.2 percentage points from German GDP. Is that the sum total of the impact on the German economy, or does that have ripple effects through the German economy that aren't being picked up by the scale of that number? Because that seems really small, and it seems like something, well, you maybe don't worry about then.
Yeah, so that would be like only the direct effect that our economists estimate. Obviously, there could be some more ripple effects, or there will likely be more ripple effects. So the impact, I agree with you, would likely be larger than that.
Would likely be larger, okay, and so I guess partly that will be determined by the types of tariffs and the extent of them, so we'll maybe leave that maths task for later. What about sticking with Germany and the perspective there? What's the investment community looking to the German government to do, whatever the German government looks like come February? Is it all about the debt brake, or is the debt brake, changing the debt brake, a necessary but not sufficient part of what we need to see in Germany, or maybe not even necessary and other things are required?
I think so. It's definitely a part of what is necessary. Without the debt brake changing, I don't think we will see an acceleration in growth. And you see that clearly if you map basically the spending that other economies did during and after COVID, and that we did, and we're all lowest. So I feel like that's definitely something that needs to happen. I think we can all agree, and that's also the investor sentiment, that this will alone not be enough. So you need structural change with that too. So you need to do something about the energy costs, which have obviously in the US declined since pre-COVID and increased in Europe, in the UK as well, and in Germany too. So that needs to be addressed for sure. And lastly, also the bureaucracy. Right, so easier processes and just also a more clearer direction from the government, so companies can feel more comfortable in where to invest.
I also wonder what euro-dollar at parity and maybe lower taxes, going from 30% to maybe down to 25% corporate taxes, could do to the German corporate outlook. Madeleine, thank you very much indeed. Greatly appreciated. Madeleine Rohner, portfolio manager on the global equities team at DWS. Core 6 looks like this morning. There's some significant stocks that are worth watching out for. We are seeing a big pop higher in Burberry, but what you're not getting is that similar pop in LVMH. Got a new CFO at that business. The stock is down this morning, as you can see. Elsewhere, Novo soft. The drug sector is broadly soft this morning. Nestle is a little soft this morning. But Ferrari's up. And when it comes to the kind of the AI trade, look at what's happening with Siemens. Look at what is happening with ASML this morning. Schneider's up 0.7% as well. There's a bunch of stocks this morning that are pricing in that grids network connection story. And it's interesting to see how strong that is. But ASML up very nicely this morning. Big points gain for the stock 600. Let's deal with some individual companies on a more granular level. Joe Easton's got the details.
So I want to start in the Italian banking space, Guy, because we are seeing a lot of action in this market this morning. Remember, last night we had that breaking news that the Italian government was offloading around 15% of Banca Monte dei Paschi over in Tuscany, and that stock gaining around 9%, even though there was a slight discount on the share placing. The thing that's moving it is the speculation that this could potentially lead to an eventual takeover of the Italian lender, as the Italian government is looking to fully exit the stake. Banco BPM, BAMI, picked up around 5% of the stock, and Anima Holdings, which is an asset manager, also picked up some shares. There is a JPM note saying BPM will eventually bid for Paschi maybe within the next year, according to analysts. That's driving those stocks at the moment. Then Siemens, this was a nice gain. As we've been discussing, it is due to mostly their data center focus, so really leaning into that AI trade, as Guy was mentioning a moment ago. That is making up for losses, continued losses in automated factories, which has been really hit by a slowdown over in China. But we can see a very nice gain for that one for Siemens, up almost 6% at the moment. Then Burberry, this is another big gainer. Finally, a bit of positivity for the long-suffering Burberry investors. Remember, the stock down 70% over the past couple of years. They're warning of 35% sales drops over the next year, but the stock's up 8%, just telling you that all this bad news probably now priced into the market, therefore getting a bit of a rebound finally on Burberry today. Then over in renewables, one stock not getting a rebound is SMA Solar over in Germany. warning of weakness in solar panels sold into residential buildings. So this is a European-based company, does Germany, but also other countries as well. A warning last night, further declines in sales, and that stock getting slammed today, down 20% almost at the moment. And then finally, in the auto space, breaking news coming out of Volvo this morning. This is Volvo Cars announcing the sale of their stake in Link. This is a company that's joint owned with Geely over in China. They're announcing a sale of that, exiting that, as I say, and the stock is gaining 3% over in Stockholm. Bit of positivity in autos this morning.
OK, yes, some really fascinating individual corporate stories. We're getting further lines coming through on Burberry as they have that host that call with journalists. So we'll get back to that story. We'll also talk about what's going on in Germany at a political level and at the corporate level. Coming up, the German Conservative leader Friedrich Merz has launched his election bid with a stinging attack on Chancellor Olaf Scholz. We'll get the details of that next and of all of these earnings stories that are coming through this morning. This is Bloomberg.
And that is why I will request a vote of confidence on December 11th, so that the Parliament can decide on it on December 16th. And that is the basis for the elections in Germany, so that the citizens can say how things should continue in this country. You are dividing the country. Mr. Chancellor, you are the one responsible for this controversy and for this division in Germany. This is simply no way to govern a country.
German Chancellor Olaf Scholz and CDU opposition leader Friedrich Merz speaking there in the Bundestag yesterday. We're getting an early indication as to what this election campaign is likely to look like. Let's get more on this unfolding political story. Oliver Crook joins us out of Berlin. Set it up for us, Ollie. What do we get yesterday? It was a tough day in the office for Olaf Scholz, certainly at the Bundestag.
Yeah, you could certainly say that, Guy. It was really very tough for him. I mean, he had to speak before Parliament and then just basically get lambasted by Friedrich Merz and a number of others, and really each of them setting out their stakes and kind of where their positions are going into this election campaign. I mean, maybe almost the official kickoff of the election campaign. And what Olaf Scholz did is he stuck to the things that he's done in the past, basically saying that you do not need to choose. Germany does not need to choose, does not need to trade off between having investments into companies and investment in infrastructure, investment in security, investment in good jobs, investment in pensions, investment in defense. These are two things that are not mutually exclusive, and that Germany needs to do both of these things all at once, which is why one of the many reasons he's in favor of releasing the debt brake. He also sort of put out his position on Ukraine and tried to really spin his reticence to give more support to Ukraine in terms of the permissions to strike deep within Russia, saying that he is a chancellor that will not escalate the conflict, and this is very important. Those are all positions that are in very sharp contrast to Friedrich Merz, who is very open to cutting things back on the social welfare state, has spoken for a long time about the need for Ukraine to be able to strike within Russia. But Friedrich Merz also said that he will not be basically joining Olaf Scholz and the SPD on any legislation, basically. So you're going to get a couple more lost months arguably, that really Germany needs for its economic recovery and direction politically.
And so, Ollie, the issue then that hangs around German politics, the big question, you've mentioned it, the debt brake already. I mean, is there any realistic expectation that that brake is released? We get quite mixed views around this desk, I have to say, about the importance of that or the to what extent that is integral to the change that's required in Germany.
Yeah, I mean, absolutely. I mean, your last guest just saying that it actually is a fundamental part. I mean, listen, Robert Habeck, the economy minister from the Greens, has likened it to sort of boxing with your arms tied behind your back, not just because of the difficulties that Germany has on its own economy, but because the rest of the world is debt financing all of their issues away, whether it's the United States. Obviously, China takes a very active hand in their economy. For Germany, though, there's this sort of generational trauma. There were months in the Weimar Republic where inflation reached 30,000%. We're talking about basically 1,000% inflation every single day, which is why they have added it here, the debt brake to the Constitution. It is sort of Article 115, where you cannot, borrow in excess of 3.5% of GDP. What is interesting is we're starting to see a shift on that, potentially from Friedrich Merz. He was speaking the other day saying that, of course, the debt brake can be reformed. The question is, why and for what purpose, which I'll leave you with the sort of irony of the sort of political situation that we're now facing in Germany, where you had a left-leaning socialist government that fell apart because a finance minister refused to reform the debt brake in order to basically elect a right-leaning government that has always been sort of very sort of faithful to the debt brake, and maybe it'll change under them.
Some people carry around a Bible. Bloomberg's Oliver Crook carries around the German Constitution. We thank you so much for breaking it down for us.
My second
out
favorite
of Berlin.
Constitution.
Of course, keeping one eye. His second favorite Constitution. He says, well, we got an eye, of course, on German stocks. We also got our eye on ASML shares. Those rising after the chip machine maker maintains its bullish 2030 outlook as it bets on an AI-driven boom. Let's get to Bloomberg's Charlotte Hugh Morgan for more. Pleasure to have you back around the table. Charlotte, walk us through the details of the outlook.
That's right, Kriti. So today, ASML is holding an investor day, and this morning they announced that they were keeping their 2030 sales outlook unchanged at 44 billion euros to 60 billion euros. They also pledged to return lots of capital to shareholders in the form of dividends and share buybacks. And this is a kind of important bullish signal to the market because ASML shares, as we know, have been under pressure recently. Just last month, they cut their guidance for 2025, and third quarter bookings also came in under analyst estimates. So this is them saying, OK, long term, the outlook is rosy.
In terms of what is going to drive that, they're pushing the AI trade this morning. They're making it very clear that this is the long-term trajectory. Isn't that already in the price?
Yes, to an extent, but I think they're reiterating that. What they're saying is, you know, it is all about AI. We're seeing some market weakness next year, that hence the 2025 guidance cut. But in the long term, they're saying, you know, the demand for our chip-making machines. And, of course, it's important to remember ASML is really a bellwether for chip makers globally. Yeah. You know, it makes the type of advanced lithography machines that they're the only people that make them, and, you know, the likes of TSMC need them to create the semiconductors that power, you know, AI and AI growth. So they're saying, look, they're doubling down and they're saying, yes, long-term demand is strong. You know, AI is going to keep growing.
That's the future, they say. Charlotte, thank you very much. Charlotte Hughes Morgan with the latest on ASML. We go quickly to another corporate news story team this morning, which is the Burberry story, and incredible moves in the Burberry share price. It's not what it used to be, but it's up by 11% this morning. And we've got the conference call, the call taking place, the management talking to journalists, certainly on talking to reporters, talking about the Chinese customer will eventually come back, believes that current China trends are cyclical, which is interesting. And this is a new CEO, and there's a lot on his plate in terms of turning this business around. If we look at a longer-term share price chart of this business up against some of the other luxury names, you can see that, yes, they've all been victims to the same fallback in Chinese consumer demand, but not to the extent that Burberry has been, and other negativities around the business. Did they misstep on pricing, on the actual range? Should they retreat back into the outerwear region?
That's where the CEO is saying they have the greatest potential. Outerwear is where the strength lies. He's also talking about bags under 2,000 euros being the kind of the area in which they would focus. That seems to definitely be a step back into the idea that Burberry needs to be a more affordable. It has maybe pushed its pricing too far. Certainly seems to be the suggestion. But he's sounding quite positive. Like, I guess he probably has to be. He's just come into the company, so he can't exactly sound too downbeat. Yeah. But he does sound quite positive. But it does feel as if there is a little bit of a reset going on here in terms of where Burberry is pitching itself.
Well, I thought it's interesting that he's not making any comments on the M&A at all, especially because Andrea Felstead, our Bloomberg Opinion columnist this week, had said that if not Moncler, Tapestry might be another major kind of player to look at Burberry as well, simply because that idea of kind of mass marketing and mass consumerism is a little bit of the American playbook there, and that's where Tapestry has, one, lost value, but two, excelled.
Right, yes, and so maybe Burberry got ahead of itself, got over its skis in terms of pricing, and he does seem to be saying some of the things that the market was looking for this morning around pricing and around that focus on outerwear. And I guess, you know, if that's what investors were looking for, if they'd all read the previews, if they'd all been reading the same analyst notes, then that's what they would have been looking for. So that's certainly one we're focused on, and that stock up by, as we said, 11% this morning.
There is a strong AI theme. Let's take it back to ASML maybe this morning. There does seem to be a strong AI theme running through what we're seeing today. So Siemens is certainly one of those stories. We've seen it over the last couple of days. Anybody that seems to have a sort of network connection, grid, energy connection business seems to be doing really quite well. FH this morning is another company that's doing quite well in that space. Siemens was there yesterday. Siemens Energy was talking about it as well yesterday. Their gas business is doing very well. That does seem to be maybe where Europe, it doesn't have the NVIDIA, but it does have the the bits that feed NVIDIA.
We talked about Siemens Energy yesterday, Kriti, and there we've got a business that's been, has been beaten up and has the potential to be beaten up again by another Trump administration because of wind power and exposure to that. But to Guy's point, if you've managed to pivot the business and it's very much more about data centres and connectivity, then maybe the market looks to that and not to the wind fragility.
Oliver Crook made a really interesting point, which is that this week, in just the last 5 days, you actually made more money on Siemens than you did on Bitcoin in terms of the volatility. I thought that was fairly interesting.
Certainly a theme that we'll continue to focus in on. Let me tell you what's coming up on the programme. Don't miss our exclusive conversation with Stefan Boujnah, the CEO of Euronext. We will talk there about what another Trump era will mean for Europe. What does it mean for listings of European businesses, European growth? How much will that be on the back foot as a result of Trump's policies? And what will that mean for the listing environment in Europe? We'll talk about that. We've also got other things to discuss around regulation as well. This is Bloomberg.
Morning, folks. This is the opening trade. We're 30 minutes into today's session. This is what the equity story looks like here in Europe. Broadly higher, with the exception, as you can see, of London, where commodity stocks are acting as a little bit of a drag. Actually, some of the healthcare stocks are also maybe giving back some ground too. Let's talk about what is happening with Euronext. At the centre, you could argue, of the European equity story. The company recently unveiling a €300 million stock buyback as part of a new 3-year strategic plan, which is designed to accelerate revenue and earnings growth. The exchange operator's CEO is, of course, Stefan Boujnah. He joins us now for an exclusive conversation. Stefan, great to have you on the show. Look, the question we're asking everybody at the moment, and it'll be interesting to see how your strategic plan fits into this, how does a Trump presidency affect Euronext?
Too early to tell. The only certainty with a Trump administration is that we are entering into an era of uninhibited decisions. Uninhibition creates unpredictability, and unpredictability creates volatility. So for the moment, we are seeing the volatility aspect of the Trump administration. But you may have noticed that appointments, nominations in the field of economics are still to come. And you may have noticed, too, that we don't know what will be the gap between what he has promised to deliver and what he will deliver. You may have noticed, too, that we don't know how his tax reduction plan will translate into deficit, how much the deficit will translate into debt, and how much of this incremental debt will translate into inflation. So too early to tell fundamentally. One only thing which is sure is we are getting into times of uninhibited decisions.
OK, so we're going to get more volatility, which in theory you could argue is good for an exchange. We are, though, already seeing European stocks once again lagging the United States. Since he's been elected president, US stocks have taken off, European stocks have lagged. Does it just once again speak to the idea that companies want to list in the United States, that investors want to invest in the United States rather than Europe? Is he only going to enhance that gap that exists across the Atlantic?
No, it doesn't tell anything about where companies want to list. It tells about the level of valuations in the US versus the level of valuation in Europe, which is a totally different concept. Companies that want to list in Europe, by the way, want to list on Euronext. You may have noticed that Euronext today is a market which is integrated and twice bigger than the London equity market. It's a market where we trade 10 to 12 billion average daily volumes in equities, so twice the size of the London equity markets. Also, in terms of aggregate market capitalizations, we have an aggregate market capitalization of companies listed in Euronext of 7 trillion euro. So when international companies want to list in Europe, they list on Euronext, and we don't have a flow of international companies leaving European markets, continental European markets, to the US. There is a situation which is specific to the UK with an exodus of UK-listed companies to the US, but that's a totally different situation that is driven by pure London factors and that are different from the rest of Europe.
Can I ask you about listings in Europe a little more then, Stéphane? Good morning. There have been hopes in the French market, for example, that the likes of BlaBlaCar or Dr. Blib might come to the market. You probably don't want to comment specifically on those names. But does it seem to you that the environment for listings in France is a positive one, given global uncertainties, given domestic political uncertainties?
Yeah, first of all, in Europe, in Euronext markets, we have a single integrated liquidity pool, a single integrated order book, a single integrated technology platform. There is no Paris market, there is no Amsterdam market, there is no Milan market, etc. There is a single integrated pan-European market under the helm of Euronext. So these
but there is Paris
that you
politics.
are referring to are important. Yeah, there are Paris politics, but if either you refer to Paris politics and taxation, etc., or you refer to listing, if you go to listing, what my point is that there is a European listing platform with European liquidity. The liquidity on this single European market is much bigger than anywhere else in Europe and anywhere else in the UK, and that's for the listing part. Now, if you ask me what are the impact of local taxation debates in France, that's a totally different question. I'm not sure there is any connection between the plans of the companies you have mentioned and the current debate about the budget, which, by the way, the dust is going to settle because in our constitutional system in France, I'm just referring to the French, but which is a small part of the Euronext market. For the French part, I mean, the system is going to be fixed in the coming weeks. The budget bill is at the Senate now, and then it will be submitted to the Parliament again in a very, very stable manner. So we should not overinterpret the volatility that may have existed for a few weeks in parliamentary debates in France.
Stéphane, let's get to the really exciting stuff here, and that is the consolidated tape. Guys making fun of me, but I'm obsessed with this story simply because it's so crucial to some of the commentary that's been happening in the EU and certainly in the Draghi report as well. Stéphane, you have your hesitations on the consolidated tape, and as we get closer to June of 2025, which I believe is when it's meant to be initially kind of set into motion out of ESMA, walk us through some of those concerns.
I'm glad you are excited by the consolidated tape concept. It's a fascinating approach of an aspect of European regulation, which is very innovative in many ways. As you know, the level 1 regulation enacted by the Parliament, the European Parliament, provides for a real-time, anonymized level 1 consolidated tape, which is a new concept. Various consortiums are being put in place to bid for being the operator of this interesting new innovative concept. And the process will start in 25 and probably for delivery by the end of 26. So let's see where we are when this consolidated tape comes to light. But I would encourage everyone to remain very cautious about what it means for real and the implications for real of this creative concept.
Stéphane, you've made the comment in the past that a pre-trade consolidated tape could endanger some of the retail trading involved in the Euronext. Walk us through what that looks like. Is there really enough retail investment in the exchange for that to be threatened?
There is a growing participation of retail investments, and we want to encourage retail participation in exchanges in Europe in particular. You know, one of the main differences between the US and Europe is that in the US, retail represents 30% of any order book, 3-0, and in Europe it represents 3 to 5%. It is increasing. We want retail to participate more. There is this trend that has started, and we want it to be encouraged. We believe that a full consolidated tape would create a situation where insiders would have access to good prices, and retail investors will get the leftovers in terms of spreads. So we don't like it, and that's why we believe that an order book, a transparent order book, is the best place for retail to contribute to the market and to benefit from the market.
Stefan, you made the comparison to the United States, but in the United States, where retail activity, to your point, has been increasing pretty substantially, a consolidated tape is part of that, simply because some of the platforms, like Robinhood, among many, many others, have access to some of that pricing as well. Does that not apply in Europe?
It does not. It does not, and we have embarked, all of us, investors, market infrastructures, issuers, into somehow coordinated efforts to bring more retail investors to the market in a European way. And the big issue for retail now is how to make sure that we beef up in the countries where we don't have pension funds and incentives for retail investors to invest more through either retail brokers or to long-term investment through pension funds. And that's really what matters, much more than a tool like a consolidated tape, which is creating a massive unbalance between the happy few who are close to latency and the retail investors. So that's why we want to address the issues in a different way in Europe.
Stefan, what do you think of the idea that Europe is making progress when it comes to a single financial market, to cross-border takeovers in banks? We're seeing one potential deal going through, but maybe it doesn't go through because the Italians and the Germans don't see eye to eye. Where is progress being made? Is it at exchange level? Is it a consolidated tape? Where is progress?
Let's park the consolidated tape issue, which is not really the material transformation that anyone could expect. Let's focus on consolidation. I mean, a few companies have been consolidating. I mean, Euronext is an example of that. I mean, a few years ago, everyone was saying LSE did not manage to merge with Deutsche Börse. Hence, cross-border consolidation in Europe is impossible. And since that failed merger, Euronext bought the Irish Stock Exchange in 2018, the Oslo Bourse in 2019, a CSD of Copenhagen in 20, and the Borsa Italiana in 21. So consolidation is possible, and in market infrastructure. In banks, as you know, the debate is not so much the surface of things, which is the political sensitivities, but whether or not prudential ratios, so liquidity ratios, capital requirements make sense in terms of creating large financial institutions. Things are going to change. I want to insist on that point. The type of regulatory environment we have been used to in Europe in terms of prudential ratios, in terms of regulations of banks, in terms of antitrust control are going to change in the coming years. The commitment of the new Commission, the commitments of the leaders at the European Council is clear. We are in an era where Europeans are not going to watch desynchronization and divergence in the US and in the UK and do nothing. So there will be a new effort on competitiveness, and consolidation will start now. Here and there might be some sensitivities at the political level. They are definitely the surface of things, and these consolidations will go through without going to any specific case. Will go through because the environment for consolidation will be different and more flexible to accommodate the build-up of strategic, autonomous, strong European institutions in large asset management players, with large investment banks, with large market infrastructures, and that's the direction of travel for the months to come.
Let's hope so. We've been waiting a long time. Euronext CEO Stefan Boujnah joining us. Thank you very much indeed, sir. So the consolidated tape, do you get the impression that it's coming soon as a result of that conversation?
Maybe not from Stefan Boujnah's perspective, but there have been folks that have entered, to his point, into that race. And ESMA will, I believe there's an introductory phase 1 in January, and then the final approval in June. The reason that this matters, and specifically for the context of the Euronext exchange, is how it incentivizes institutional flows or retail flows. We've had this conversation in the United States in terms of how much retail flows are changing the entire market. From that conversation, it feels like Stefan Boujnah might be more interested in attracting the retail flows over the institutional flows, but of course the institutional players lobbying for that consolidated tape.
Yeah. I've been trying to ask lots of guests recently whether Bitcoin is a threat to retail trading generally. But I mean, you know, we can talk about the market infrastructure as well. But that seems to be on people's minds as we think about another Trump presidency, and takes us on to our next conversation.
We're not talking about that anymore. We'll talk about Bitcoin next. I suspect the Kriti wants to talk more about the consolidated tape. That will be coming up in a programme very shortly, I can assure you. Bitcoin, as Anna says, hitting a new record. I think we're north of 90 this morning. The Trump rally resumes. More on the moves next. This is Bloomberg.
To stop this onslaught at lower prices, I'm pledging today that in my second term, we will eliminate a minimum of 10 old regulations for every one new regulation. We'll be able to do that quite easily, actually. And instead of attacking industries of the future, we will embrace them, including making America the world capital for crypto and Bitcoin.
President-elect Donald Trump speaking about Bitcoin in September, and it seems that the market for cryptocurrencies was listening, because the biggest cryptocurrency is now up more than 30% since Election Day on November the 5th. We're joined now by Davila Silinskita, who's Director of Digital Asset Research at Wisdom Tree. Thank you so much, Davila, for coming to talk to us. Does it make sense for Bitcoin to be up more than 30% since the Election Day? Does that meet any valuation criteria that you're looking at?
Good morning, and thank you very much for having me here today. Very, very happy to talk about this. This year has been extraordinary for Bitcoin. To begin with, we see an increasing demand from institutional clients, as now they're able to invest into Bitcoin via wrappers that make sense to them, that is, exchange-traded products. We also saw reducing supply of Bitcoin due to its fourth halving that Bitcoin went through earlier this year. The combination of continuously increasing demand and recently reduced supply created price positives for Bitcoin. And now it also has strong US election tailwinds because of the promises that Trump made during his candidacy.
Yes, indeed, and so that's something that has pushed the price of Bitcoin up really substantially, as we mentioned. I wonder if we think about the different dynamics, the things that might drive the price higher. There's a lot of people talking about whether we're going to see the creation of a government-owned Bitcoin reserve, and I wonder how much that matters. We caught up with Mike Novogratz, the CEO and founder of Galaxy Digital. Let's just have a listen to what he had to say.
I don't necessarily think the dollar needs anything to back it up. To need to back up the reserve currency is counterintuitive. And so, again, listen, if we get the Bitcoin reserve, and as a guy that owns a lot of Bitcoin, I will not cry. And if you see me crying, there'll be crocodile tears. I think Bitcoin heads to 500,000.
OK, there's a couple of things to unpack there. He's not too worried about whether we get this Bitcoin, the government-owned Bitcoin reserve. He also thinks it goes to 500,000. But let's deal with the reserve first. The government-owned Bitcoin reserve. Does that matter, Davila?
It would be very, very positive for Bitcoin price. Of course, this is also one of the promises that was made over the past few weeks. And we will have to see how many of Donald Trump's promises can actually be implemented. So investors for now should expect volatility in Bitcoin price until there is more certainty.
Let's just talk a little bit about what is happening here. Isn't Bitcoin just the high beta play on the Trump trade, and it's not really got anything to do with fundamentals? Is this more about vibes than vision?
Bitcoin has very strong fundamentals as store of value. One of the items that is becoming more and more visible is Trump's tariffs and government spending is likely to lead to increased inflation. And Bitcoin as a store of value has a great promise to Bitcoin investors because they'll be able to benefit from Bitcoin appreciating in price as inflation potentially takes hold.
Davila, a final question to you. Let's talk a little bit about the mining infrastructure as well. So much of that feels tied to energy and specifically the grid infrastructure in the States. What does that look like? What does mining, what does supply of Bitcoin look like?
Bitcoin mining is the essential component of Bitcoin as investment vehicle, because Bitcoin mining is a clear and visible to everybody way of Bitcoin supply. Bitcoin miners themselves are based all around the world, and they tend to tap into the energy sources that are cheaper and more abundant. But Bitcoin mining, the frequency of new Bitcoins being issued as blocks are confirmed is very, very visible to every single investor who is accessing Bitcoin. And recently, this was reduced from just over 6 Bitcoins per mined block to just over 3 Bitcoins per mined blocks. So Bitcoin supply has reduced significantly. And in the past, this has led to significant price appreciations. After the fourth Bitcoin mining, we have not seen that type of price appreciation, as the impact on the change in supply was slightly smaller than what we have seen during the first 3 halvings. But this lagged impact on Bitcoin price is expected to show itself over the coming weeks.
Davila, we will leave the conversation there. Davila Silaskita there, Director of Digital Assets Research over at Wisdom Tree, walking us through some of the dynamics over in crypto as well. We'll see if that rally continues. We are looking at the moment at a 90,000, just on the cusp of 91,000 for the Bitcoin price. Let's talk about what else we've got going on throughout the rest of the day. The next 24 hours, 1:30 p.m. UK time, some economic data out of the States to watch out for. U.S. PPI plus jobless claims as well. Then just 6.5 hours later, we've got the Mexico rate decision. You want to keep an eye on the peso here. It's really taking a beating as part of the carry trade as well, given the moves we're seeing in the yen. Certainly a little bit of volatility there. Plus, then, all eyes on, I think, what are maybe the stars of the U.S. and the U.K. at the moment. Powell at 8 p.m. speaking on economic outlook. And then Rachel Reeves speaking at Mansion House later today as well.
Let's talk about Powell. Valerie Sartel sitting around the table with us. The market basically is still pricing in December. Mm-hmm. Swaps markets moved to about 80%, but beyond that, it looks really uncertain. Is he in a position now that he can give us any clarity as to what happens at the beginning of next year? And is that what the market is going to be looking for? Or is it just that 80%? Can I price that in with a degree of certainty?
Well, look, Guy, not only is he going to say that they're data dependent, but they now are going to be policy dependent out of what we get from the new Trump administration. And he's said that he doesn't want to speculate. But today, you know, there is going to be Q&A after his speech, and he might get some questions where, you know, he could speak a bit more freely about how he's viewing the December policy decision. It's notable that he's speaking after we get the PPI data, so he'll have a good gauge on where PCE is headed this month, and maybe he'll want to give a hint to the market that a December cut is on the table. Perhaps that would take some heat off of him from the Trump administration. We also expect him, you know, to maybe get asked a question on Federal Reserve independence and how he's feeling with dealing with a new administration who seems to be a little bit more involved when it comes to the monetary policy decisions.
Yeah, it does seem as if that is a part of the relationship with the Trump administration that he will talk about, even though he doesn't seem to want to talk about any of the policy possibilities. So what is the market watching here, Valerie? Because does any of the Fed commentary really matter if they're not going to engage? And we understand why. Mm-hmm. But if they're not going to be jumping at shadows and not going to be engaging in conversations about what Trump might do, is the market listening?
It's very complicated for the market right now. Do we care more about Powell or do we care more about the cabinet makeup that the new Trump administration is putting together? And if you put all that together, you know, the first thing that I think the market is really touchy about is tariffs, because the Trump administration does not need any okay from Congress to pass measures when it comes to tariffs. But even in that, you have to think about the more lasting implication for inflation is not just the tariffs, Anna, but do we get retaliatory tariffs? So again, this narrative over are Trump's policies inflationary, it might all be down to what policy he decides to attack first. Is it going to be tariffs, or is it going going to be deregulation and tax cuts? One which would be negative to growth, another which would be positive to growth. Is he going to perhaps push forward more of this energy policy, deregulation of the energy policy, which could bring oil prices down and perhaps push a more deflationary impulse into the U.S. economy? Which one is he going to attack first? And it's still very much up in the air to that effect.
Certainly something we're keeping a very close eye on. Valerie Titel, they're joining us around the table, talking a little about that dynamic between the executive branch and the Federal Reserve as well. Coming up later today, you don't want to miss our interview with JP Morgan CEO Jamie Dimon. That coming up at about 7:30 p.m. UK time. Imagine everything Valerie just laid out will certainly be fair game for that conversation. Our very own Lisa Abramowitz conducting that interview. In the meantime, markets mostly green on the screen. Stick with us. It does it for the opening trade. Pulse is up next. This is Bloomberg.